Baruch Lev, The End of Accounting and the Path Forward for Investors and Managers, Wiley Finance. Welcome to the world of The End of Accounting and the Path Forward for Investors and Managers, where you'll explore the outdated nature of public company financial statements and their decreasing relevance for modern investors. This book summary will journey into the unchanged accounting practices and how they struggle to adapt to the rapid shifts in the economy and various sectors. Discover why accounting is resistant to change, the concept of path dependence, and how intangible assets are impacting the investment landscape. Be prepared to uncover the reasons behind the declining usefulness of financial reports and the potential solutions for this long-standing issue.
The resistance of accounting data to change. The 20th century witnessed profound changes in almost every aspect of society except public company financial statements, which remain remarkably static. Despite the revolutionary changes that occurred over time, accounting systems did not evolve accordingly. Annual reports have become significantly longer, yet most of the added content is meaningless fluff. The reasons behind the reluctance of accounting data to change are shrouded in mystery. Although ideas such as triple-entry accounting were proposed, they never gained traction. The adherence to double-entry bookkeeping despite its age and limitations has contributed to the absence of innovative accounting systems that could better reflect the ever-changing business models, operations, and values of modern companies. The evolution of investing. In the past, financial reports were the go-to source of information for investors. However, with the emergence of sophisticated research, this has changed. Despite this, corporate earnings remain a crucial aspect of evaluating companies. Exxon, as a case in point, has maintained its profitability for years, making it easy to predict its future earnings using simple calculations. Surprisingly, such predictions often outperform expert forecasts. Nevertheless, investors should remain aware that reported earnings may contain estimates. The rise of earnings forecasting has led to a decline in the significance of reported earnings, with earnings surprises having a considerable impact on stock prices. For instance, IBM's poor quarterly earnings announcement in 2013 led to a 7% drop in share prices due to fundamental problems with their business model. The flaws within earnings calculations. Companies' earnings are calculated by taking into account unusual, one-time charges that can create volatility in the bottom line. These charges reduce the reliability of earnings as a predictive tool, making it difficult for investors to rely on them. Additionally, traditional accounting has no rules to isolate the effects of one-time charges, which can create false signals for shareholders. Intangible assets contribute heavily to business value, yet they are not fully reflected in corporate financial reports. As a result, sophisticated investors have learned to not react strongly to missed or beat earnings forecasts. While there is a measurable difference in performance, it is not significant enough to warrant press coverage of earnings calls. Investor irrationality. Investors may be the cause of unstable financial markets, not accounting practices. The dot-com bubble of the late 90s showcased how investors were putting money into companies with no assets or earnings, leading to price bubbles. However, if irrationality was the new norm, stock prices would be untethered to fundamentals. This hasn't occurred. Facebook's IPO was viewed pessimistically by investors, leading to a fall in share prices. The rise of conceptual industries. In the late 1970s to early 1980s, the U.S. economy saw the emergence of new industries such as software and biotech that dealt in intangible assets like intellectual property. This signaled a shift from the traditional manufacturing concerns of old industries, where balance sheets were filled with physical assets. With the advent of the internet and social media, the rise of conceptual industries hastened and challenged traditional accounting practices that were focused on material goods. The book points out that by the early 2000s, outdated bookkeeping procedures had failed to keep up with income generated by non-physical assets like patents and technology. The deception of financial statements. Financial statements have been the primary source of buy-sell information for investors, but their problems go beyond timeliness and rationality. The three main factors leading to their demise are the treatment of intangible assets, the post-fact era of accounting, and unrecorded events affecting corporate values. Intangible assets are increasingly responsible for corporate gains, but there is no reliable way to value them. Accounting has entered a post-fact era, and numbers are often sheer guesses. Accounting fails to reflect events that can dramatically change a company's fortunes. Investors who rely solely on the information offered by financial statements make poor investment decisions and can incur financial losses. The amount of relevant information conveyed by corporate financial reports is far less than believed. Accounting principles can artificially depress company equity and mislead investors into thinking that a company offers a promising business model. As such, investors should apply appropriate levels of skepticism to numbers that they mistakenly believe to be immutable. The downside of declining financial reports. Declining financial reports may seem insignificant, but the loss of relevant information has consequences. Investment research has decreased, making investment decisions less informed, leading to severe losses. A new approach to accounting is needed, treating intangible assets as tangible, simplifying accounting rules, and providing descriptions of non-traded assets and liabilities. This change in direction will not only benefit investors with better accounting intelligence but also offer companies a reliable financial reporting system.
As you conclude your journey through the end of accounting and the path forward for investors and managers, you're now aware of the glaring issues with outdated accounting methods and their decreasing relevance for today's investors. You've grasped the importance of understanding the meaning behind reported earnings and how they no longer hold the same potency for decision-making. Furthermore, you can now appreciate the influence of intangible assets on corporate value and the need to treat them with the same significance as tangible assets. As you venture beyond this book's summary, take with you the realization that accounting and financial reporting must undergo significant changes to support smarter investment decisions and further innovation in the world of business.